Welcome to today's Dealmaker event on what's next for venture capital. I'm Dan Primack, business editor at Axios, coming to you from Boston. Big welcome to our audiences on social media, Facebook, YouTube, X, LinkedIn, and of course, Axios.com. Please follow along today's conversation on X with @Axios or hashtag Axios events. This is our third installment of the 2023 Dealmaker series, and we're kind of looking forward to 2024 and what's going to happen in the market. And our first guest today is the co-founder and managing partner of Oak HCFT, which stands for Healthcare and Financial Tech, Annie Lamont. Annie, welcome.
Hey, thanks, Dan. Sorry about the Patriots.
Yeah, let's move on let's move on to finance. So Annie, let's talk a little bit healthcare first. If you look at the numbers, this is true throughout venture as a whole, but healthcare a little bit more. It was a rough year in terms of number of deals, in terms of value of those deals, whether that be in biotech, devices, health tech. Tell me one good thing, one green shoot you actually saw in 2023.
The green shoot. Well, I think what we saw was a lot more discipline by entrepreneurs, and that's ultimately going to be a very good thing in terms of how well the companies do, because it all comes down to, can you execute and operate these business models that they've created? And I think that's a real plus. And you've got a lot more experienced healthcare entrepreneurs that have come into the market the last 5 or 6 years. And it's always good to, fail and learn a lot from that. So.
I'm curious, the buzzword of tech, but also of venture is AI, and everything is AI, yeah. Everything is AI enabled. And I'll have a conversation later in this series on this. In healthcare, that's definitely become a big part of it, particularly verticalized within healthcare. Is basically every startup you're looking at right now, if not an explicitly AI company, at least one that is planning to incorporate it or hopes to incorporate it in some way?
I would say, look, healthcare is less driven by the importance of tech than other sectors. But absolutely, everyone should be using Gen AI to make their own internal operations more efficient, as well as thinking about incorporating it in the product. So, I would say that this is, one of our newest companies is a spin out from Cedar and is focused on rev cycle management using Gen AI, to do things better. So I think it's going to be just an inevitable part of every company, including our own firm has to be using it to do what we do better.
When you say that, what does that mean? How is Oak using Gen AI for its own operations as opposed to its portfolio companies?
Simple things like the fact sheets on every company and the assembly of data. If you're looking at market analysis and research, we should be using, and we are starting to use Gen AI in all of these things in our financial FinOps, aggregating of data and looking at market research.
I'm curious, Alan Patricof, who is probably kind of the grandfather at this point of venture capital, has been around longer than me. He told me recently that from his perspective, AI is the biggest platform shift of his career, and then pointed out that career overspanned semiconductors and biotech and the internet and mobile and cloud and obviously, the metaverse. Do you agree with him? Is this the biggest platform shift of your career?
I think it will be. I think it'll start slow, and then I think it will be ubiquitous. Obviously, the internet had a massive impact, but if you look at, I think it's basically 1995 to 2004, there was a 12% increase in productivity, and it was a very highly productive period. Then we went through a less productive decade. And I think over the next decade, the predictions are at least 15%, added to effectively GDP and the increase in productivity. So I think it's absolutely enormous. And as I see, even if you looked at the new version of Microsoft Outlook and how it's going to impact your life and your organization, it's very powerful.
It's interesting you raised Microsoft. Microsoft announced a couple months ago a partnership with Nuance to basically do kind of electronic health records, but incorporate AI into it. Do you feel that that's been a space that venture capitalists have invested a lot in various ways, kind of either directly or indirectly? Does that mean Microsoft Nuance win that? Do they just walk away with that entire market because of what they've done?
I think if if you just focus on voice recognition and integrating it into basic administrative tasks, they probably have an edge. But I think you've got to think about it like any other vertical software in workflow and whether it's administrative or clinical tasks. And I think what we're focused on is very specific applications of the technology. And I think with that, if you really, there's no way nuance is going to understand exactly the administrative task or the clinical task in the same way that somebody is deep in healthcare and living that user case every day. So, I think that's just broadly, yes, generic tool. We don't plan on investing in generic tools, but we do plan on, just like we have done with other vertical software, going deep in use cases.
So if 2000 and 2021, 2022 were when venture capitalists just were writing checks faster than almost their fingers could work. And then this past year, 2023, was really kind of reckoning with that and working with management and operations to kind of, if not fix things that were wrong, right-size things. Is 2024 the year of, call it, exits, consolidation, mergers? Or if not, what marks 2024, even though I know we're a few months away from it still?
Yeah, no, I think you're absolutely right. I think it's a bipolar market, and that great companies will get funded and do well, and those that are good companies or even highly challenged companies will either go away or they will be consolidated. So I do think it's going to be a very active year next year. The 2021 money is running out by 2024, and I think there is going to be a lot of consolidation in a good way. I mean, scale is a good thing, and a lot of these companies are really products, not companies, so they should be part of something else. So I'm actually excited for the year. I think it'll be a great opportunity for us to take platforms and consolidate. I also think it's actually going to be a good exit year. I think there'll be a lot of liquidity. I think 85% of our exits are to strategics, and I think they will be very active. And I think there'll be a number of companies, ready to take that step. I mean, honestly, the thing I'm most worried about there is the DOJ and FTC. And they seem, we have no IPO market, and if they make it really difficult on strategics, they're going to slow the wheels of capitalism. I mean, if we don't get money back to our LPs, they can't give money back to us to invest in new companies. So.
Do you feel, there was a lot of talk about either down rounds or companies maybe sometimes raising venture debt to kind of paper over and structure over the fact that their real valuations were lower. It's one thing for entrepreneurs and founders to kind of inherently accept the new normal. Do you think now, and you talk, I'm wondering, because you talked about consolidation and platforms next year, have venture capitalists internalized that the prices they paid during the boom times have come back down?
Yeah, no, I think they have. I think that we're very focused. I mean, ultimately, it doesn't really matter what the price is or what the valuation is today. The ultimate test is what you are able to exit a company at. So I think at this point, I think we're a fairly rational group. I think we want our companies to survive and ultimately thrive. So we've just been very focused on discipline and getting to cash flow break even, along with our entrepreneurs, and hopefully helping them to do that.
I have 2 minutes left, so I'm going to ask you 2 different questions about some stuff that's happened in the market recently, particularly in the healthcare and / venture market. The first is that General Catalyst, which is a rival firm to you guys, or a peer firm, or a friend, or however you want to describe them, said that they are going to try to buy a health system, and which is not what VC firms normally do. And it sounds like they want to buy an existing health system, almost for the sake of being able to let their portfolio companies, their tech portfolio companies, kind of play there and implement stuff that sometimes is hard to actually get implemented in a real health system. I assume you saw this story. What are your thoughts?
Well, we actually don't love the whole hospital market provider. It's very hard to sell to hospital systems, and really hard now. They're not buying, even though they know they need efficiency tools, and they will be in the future, but they're pretty focused right now on EBITDA, cash flow, anything that costs them money, even if it saves them money in the future, they're not as interested in. So it's just always been a tough market to sell to. So there are very few companies we actually back that sell to hospital systems. And to be a hospital system, look, I was on the board of HCA, best run hospital system in America. They're amazing. And we don't want to compete with them. I think it's a really hard thing to do well. For, I don't know, for a VC to actually make a VC like return owning a hospital, it's gonna be tough.
Also, very quickly, Cigna Cigna this week, I'm sorry, announced that it's kind of streamlined or simplified the way it charges for drugs. It seems to basically be saying Mark Cuban was right, and we are going to follow his path. Do you think Cigna's rivals are going to follow Cigna / Mark Cuban? Is this a new normal?
I think it may be a new normal. I think the reality is it probably isn't where they make all their money. So I think they think it's okay. I think they make their money in other ways. So, I mean, I think they're smart to do it, and it's probably time.
Annie, thank you so much for joining us today. And next, we have a View from the Top segment with my Axios colleague, Fabrizio Drummond.
Hi, I'm Fabrizio Drummond, Axios Chief Business Officer. Thank you, Cooley, for making this conversation possible. Up next, we're going to hear from Adam Denow, Partner and Head of New York Corporate Practice at Cooley. Adam, thanks for joining us.
Thank you for having me. Really happy to be here.
Excellent. Well, let's dive in. Walk us through your latest thinking on VC and growth equity investment activity through the remainder of the year. And what are some of the trends that you're seeing for 2024? What are the similarities or perhaps the differences that we should expect?
So I would say there's no question that 2023 has been a challenging year, particularly in light of how crazy 2021 and 2022, or at least first half of 2022 were. Deal activity is down. Deal volume, dollars flowing into startups is down. It's been a very challenging environment. Companies are certainly trying to do whatever they can to ensure that their dollars are stretched as far out as possible. Unfortunately, we don't see an immediate turnaround. I think that through the end of the year is likely to be a little bit more of the same. Hopefully, we start seeing some good signs heading into 2024. Obviously, we'd like to see the exit activity pick up a little bit. Once that happens, you tend to see more on the investor side as well.
Let's talk about down rounds. Do you expect the number of down rounds to tick up through the end of the year? And just going a level deeper, do you see any differences in terms of early stage versus late stage investment?
2023 has certainly seen its share of down rounds. Valuations have come down significantly. Multiples, by any measure, have come down from their peaks in 2021. And again, we continue to see those, and we expect to see those through the end of the year. In a lot of cases, however, what you're seeing is the valuation pressure bringing valuations down, but the companies have been making progress, maybe increasing their revenue, maybe just their products are taking steps forward. And so in a lot of cases, the downward pressure on valuations is sort of canceling out the positive progress, and you end up with a flat round. And so, yes, I do think that we are still seeing down rounds. We are still seeing flat rounds. We're also seeing investors just try to plug the cash holes in a quick and easy and inexpensive way by doing some sort of convertible instrument, whether it be a safe or a convertible note, with the hope that in a few months after, the things clear up a little bit, that the note will convert into an up round. So, we're seeing all kinds of those kinds of deals, which aren't the deals that we saw in 2021 where, companies were getting tons of money at high valuations. So, the good news is that these kinds of deals are happening, and it enables, good companies to continue to fight another day.
Another trend that we're seeing is venture-backed companies are staying private longer, which naturally creates excess demand for investor capital. What are investors looking for in investments today that is different than compared to 2021?
I would say the big difference is that in 2021, it was all about growth. You would have companies raising lots of money on high valuations and then hiring large sales teams, putting a lot of money into marketing, and really focused on growth. And now the buzzword that we're hearing in boardrooms and elsewhere and investor pitches is, how can we make money? How can we make our cash stretch out as long as possible, right? And whether that's getting to break even or even profitability, how could we make the dollar stretch? And so I would say companies are in a tough spot because they do need to make the dollars stretch as long as possible, while at the same time still showing investors that their company is an appealing and attractive investment opportunity. And so, just walking that line, striking that balance between growth, showing top line growth, and also being smart about how you're spending the money is kind of the secret sauce, and where the good companies are going to still be able to raise their round successfully.
Adam, investment activity has been down this year. However, there are bright spots in sectors that have been attracting the attention and capital from investors. What are the elements that you'd say make these sectors appealing, even though we're dealing with tumultuous times?
Yeah, it's an interesting point. There's no question that there are still some market segments that are attracting dollars. We do tend to see that every few years where there's a hot industry. Sometimes those hot industries end up being fads. Sometimes there's more to it than that. I would say now the market or the industry segment that we're seeing a lot of activity is AI. Clearly, there's a lot of buzz around that. There's good investment dollars going into AI and AI related companies. It will take a little bit of time, I think, for people to figure out exactly how to commercialize a lot of these technologies, and for, in some cases, the technology to actually catch up to the hype. But I would expect to continue to see some interesting companies coming in that market, and I do think that we'll start to see some good financings coming from that as well.
Maybe one closing thought here before we go, Adam. So we've begun to hear the bell ring in the capital markets since 2022. What is your projection for 2024 in terms of IPOs, and what else needs to happen or change to make it a robust IPO market like we've seen in the old days?
Yeah, well, we've clearly seen a few fits and spurts of IPO activity. We're hoping that eventually it sticks and we have a steady stream of IPOs. Obviously, there's a lot going on in the world right now. On the economic front, the Fed has obviously raised interest rates a lot over the course of the year. The latest meeting, they did not raise interest rates. And so, once we start seeing some clarity from the Fed about interest rates, I think that would shed some light on the longer term prospects of the IPO market. Obviously, we have a lot of geopolitical turmoil throughout the world right now. That's also factoring into the markets generally. We'd love to see that settle for lots of reasons, but including to make sure that we have our IPOs coming back. And then we have an election coming up, and my gut is, as I'm sure many of your viewers would agree, it's going to be a pretty contested election, and the uncertainty that brings can be challenging for the markets as well. So I think once those uncertainties and unrest settle a little bit, we'll start seeing better and more market activity.
Excellent, Adam. Yeah, we got lots to watch for in 2024. Thank you again for joining us.
Thank you for having me. Really appreciate it.
Thank you. And thank you, Cooley, for making this conversation possible. Now over to our next segment.
Thanks, Fabricio. Our final guest today is Sapphire Ventures Managing Director, Rajiv Dam. Rajiv, thanks for being here with us today.
Thank you for having me, Dan.
So let's start big picture here. 2023 was a pretty lousy year for venture capital, at least in terms of deal activity. Number of deals, amount of money invested, really across all stage, from seed all the way up through growth, which is where you focus. Do you expect that there's going to be a pickup in 2024, or is it just a continuation of what we've seen for the past 12 months?
It's a great question, Dan. I would characterize the current sort of downturn in private market VC and software activity, which is where I focus on growth stage B2B software companies, broken up into a couple of phases. First, phase one was the valuation correction that largely happened last year. Sure, there's sometimes some bid-ask spread on some companies, but that largely happened last year coming into early this year. This year has been really the operating performance correction or stabilization coming out of Q3 for most of our portfolio companies. And more broadly, if you look at the public software companies, you see that Q3 is signaling that we are sort of around the bottom and bouncing up and down off the bottom versus getting materially worse. And that's what you want to see as you're trying to go forward and predict what will happen next year, just from an operating performance and bookings perspective. So I do expect next year with a little more predictability around things not getting materially worse and falling off a cliff will make it easier for entrepreneurs and VCs to transact. And especially as more companies need to raise more money because they've been so well capitalized over the last year.
Actually, I wanted to ask about that. When you think of your portfolio, but you also think of other growth stage companies out there that you're aware of and you've seen pitch decks for, do you believe there is a need for capital? As you said, the fact that companies raised so much money, kind of particularly in 2021, 2022, married with the fact that they often did some significant layoffs and other expense reductions, is there a serious need for growth capital going into next year within the software world?
It's a great question. I'd like to say that a couple of things. Number one, the go-go times didn't really just start post-pandemic in 2020. It really sort of started in 2017, 18 is when we started, inflation started to rise, round size started to bloat, VCs start to raise larger funds. And what happened was across 4 or 5 years, you had companies raising 2x the capital at 2x the pace, right? Which is a compounding factor. And so, if you look at our portfolio, I think we've had maybe one company, and even that I'm struggling to think of, have to raise capital in the last 2 years. Now, I do see when we look forward to the next 18 months, there's going to be more than a handful. It's not going to be a huge deluge, but there is going to be a handful of companies, and I do expect market activity to pick up this time next year in particular.
There's obviously multiple ways a company can raise capital. One is by going back to venture capitalists or going to new venture capitalists for later stage rounds. Another thing you could do is go public. Those are typically financing events. They bring lots of capital onto the balance sheet. 2023 has been a virtual desert for IPOs. There was a handful in September, and then the market fell off again. At what point do you, as a VC, start advising management companies, say, it's time to go. Let's move this thing public and let's take our chances out there?
That hasn't been the advice at all in boardrooms. I'm on the board or supporting probably a half dozen companies that are now north of 150 million of ARR. So really getting to that territory, or if not already at the territory where they, in theory, should be able to go public. But like I said, most companies are just trying to get a handle around their operating performance and operating cadence first and foremost, right? And making sure the metrics and the predictability of the business is clear. And so that's the advice that we give. Secondarily, IPO is just one of many financing or even liquidity alternatives. M&A will become a more popular alternative as companies that were overfunded are realizing that the growth rates are just going to be materially different going forward. And so I expect that to be a completely, by the way, healthy outcome. If a strategic acquirer or even a financial sponsor is interested in a company, it may not be as glamorous, Dan, but I think it is going to become a much larger proportion of exit outcomes in the coming year. I think the more interesting thing, Dan, is
hey, Rajiv, cut in for a second. I understand less glamorous, but also typically less lucrative for the VCs. I mean, if you look historically, the best VC returns, and there are a couple exceptions, the WhatsApps of the world, generally the best VC returns come off of public offerings.
That is true, because you're saying public offerings are less glamorous, or?
No. Public offerings are more glamorous, you said, but it's not just the glamour. If you're a venture capitalist and you're talking to your own investors, your limited partners, those public offerings also usually give more pop, give more return on the dollar than do M&A exits.
Well, there's two things. One, there's a gating factor. Can the company even go public? I think the bar has raised significantly to even go public. You probably need to be 300 million of ARR and still operating at a rule of 40 plus. That's non-trivial for most private companies that are out there that are subscale or even at mid-scale today. Two, even if you do, going public in a volatile market, as you've seen with more recent issuances, isn't necessarily the most lucrative path, and being locked up for 6 months and you're seeing the multiples sort of crater even after some of these listings versus a strategic acquirer that may want your business and have to pay a healthy premium to what a public market may pay on day one in order to acquire your business because of the implied synergies.
300 million of ARR, that is a higher bar than we've talked about in the past. It's interesting you say that. Let me go to a couple areas where you personally at Sapphire, but also you invest, and one of them is fintech. You spend a good deal of time there, it seems. I was in Vegas for Money 2020 a few weeks ago, and let's just say, particularly for a Vegas crowd, it was a dour, I don't want to say totally pessimistic, but definitely not an optimistic group of people. It feels like not only because valuations have come back, but there just seems to be a general concern that the rocket ship has stalled. I don't know if you were there or not. I'm curious your take on it.
Yeah, Dan, it's a great point. I wasn't able to make it this year, but I did have 3 of my colleagues go. They reported the same thing. I think the word that they used was subdued sentiment. At Sapphire, we obviously have a rich history of partnering with pretty great fintech companies, Square, now Block, TransferWise, now Wise, Mercury Bank, and a lot of financial SaaS companies as well, like Flowcast. I think what happened by and large in fintech are a couple of things, but one mainly, it's something I learned when I began my career at Goldman Sachs and the financial institutions group. If you have a business that is balance sheet driven, for example, lending, credit, insurance businesses, they will ultimately fundamentally be valued as such, price to earnings, price to book ratios, versus a lot of VCs and a lot of companies in the ecosystem valuing them as technology companies because there was something tech enabled about their model. A lot of those businesses came down to earth in a way that was much more dramatic than the way enterprise software sort of corrected over the last couple of years. So I think that's what you see in terms of the more subdued, because there was a lot of startups, a big proportion of startups going towards that. Now, in reaction, a lot of venture capitalists actually are looking at categorizing fintech as enterprise software companies that sell to the office of the CFO and sell financial tooling. And that's kind of more down the fairway, repeatable, high margin sort of software businesses. And I think that's been more popular as of late.
Why, I'm curious why it sounds, and tell me I'm wrong, that like from your perspective that the disconnect, or the mistake rather, the historical mistake was made on the investor side. Why was that mistake made? And so universally, not just by one firm with one company, but kind of across the board.
Yeah, it's a good question. I mean, I think you can apply that mistake being made in much more broader areas, right? What happens is in this low interest rate environment, even companies that were going public with questionable unit economics in insurance technology spaces, where the business models they were flying in the public markets. And as investors, what you look at is the public markets as a gauge of success. When you're trying to measure your return 3, 5, 7 years out, you look at what that company's being valued and you sort of apply that value in some way, shape, or form to the current business you're looking at. And so those businesses hadn't even corrected in the public markets. And when the public markets corrected, then obviously the private market valuation is correct as well.
Rajiv, it feels to me right now that each day there's a couple dozen maybe venture financings that get announced around the world in various sectors. But it feels right now that almost every one of them, no matter what kind of widget they are selling, it is an AI-enabled widget or an AI-powered widget. For you as an investor, what does AI actually mean, and when should it apply and when shouldn't it?
Yeah, it's a good question. Listen, at Sapphire, we've been investing in AI and machine learning and computer vision and a bunch of companies for, I guess, decades now. This latest advancement brings, a pretty rapid increases in the capabilities around generative AI and such. We tend to ask most companies that are somewhat relevant, do they have a strategy? I wouldn't say it's a bar where you must be a generative AI company or not. I think we try to be pretty measured with the pace. We do have $1 billion commitment to invest in B2B oriented generative AI entrepreneurs and companies, but we're being measured. We want to make sure that we take each and every company through our own standard diligence process, and not just get money because it's a generative AI company. It needs to show things like moat and durability and true customer value propositions and the metrics to boot. And I think that's where some in the venture capital ecosystem, the funding maybe has gotten ahead of the actual durability and understanding of the quality of these opportunities. And I'm happy to explain more.
Yeah, just quickly, I've got limited time, so one final question. Menlo Ventures put out a report this week talking about AI adoption by the enterprise, and it basically showed it was very low. It talked about it kind of being like the very early days of the cloud. Quickly, why do you think it is that big enterprises haven't yet really done a lot of AI spend, less than 1% of their cloud spend right now?
Listen, Dan, I think it takes time, right? I think we're still trying to figure out what are the killer native use cases for generative AI companies. I actually view it differently. If you look at mobile and cloud computing and all the other, I mean, it took time to really take off and understand what were those, for example, mobile applications that me and you use that just made sense to be mobile. It was several years later. Listen, we have the first killer app in GitHub Copilot. There's millions of developers using that app, and I think there will be others. This is a C-suite conversation at almost every enterprise. It's only really been a year or less than a year. Enterprises move slowly. Enterprise planning cycles happen at the end of the year. And so you can see a lot of people trying one or two production use cases. It will take off, but it takes time. There's worries around accuracy, around data security and privacy. Those need to be continually fixed. And I think GPT-4 was better than GPT-3 and will continue to get better. And so I actually view it differently, and I think we're supremely positive. I just think the venture ecosystem needs to make sure when in funding startups, are those startups really providing true customer value in a durable way? Or is this something OpenAI may just announce on their developer day, as they just did recently, which can be pretty frightening if you're an early stage startup.
Rajiv, thank you so much for your time.
Thank you, Dan. Appreciate it.
Thank you all for joining us this afternoon for another Axios Dealmakers event that has made us all smarter, faster. For more on what's next in venture capital, please sign up for the Axios Pro Rata newsletter at axios.com/newsletters or on the Axios app. Again, thank you all for joining, and we'll see you at axios.com.